This just plunged. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, there are red flags everywhere as the consumer crisis begins. Now, you may be aware that the U.S. consumer is 70% of the economy, and that's why you hear policymakers are constantly fixated on the strength of the labor market and the spending habits of the U.S. consumer. But as we look around the world, we see that consumption here matters a lot. And in China, what did we see happen is that after the COVID-0 lockdown ended, everyone had high hopes that the Chinese consumer would come out and spend, and they really didn't. And then you take a look at Europe, particularly in Germany. What have we seen there about the consumer is inflation is so high that it's keeping them from spending. And this all comes back now to the focus on the U.S. consumer driving the global economy out of this slump and engineering the mythical soft landing that the Fed is hoping to achieve. And now all of a sudden, we're seeing some red flags that suggest perhaps the strength of the U.S. consumer is about done. Now, if you're wondering what we're doing on an oil tanker today, it's not just because crude oil prices are rising, it's because now there's hope that China is indeed going to see a soft landing, but we're going to show you why those hopes are soon to fade. And while many believe the U.S. manufacturing sector can weather a downturn, we're going to show you why this latest crisis with the consumer that's coming is going to be a major hit to the U.S. industrial base. And with that, let's go to Bloomberg, where we picked today's story up with a headline: China economy shows more signs of stability on policy boost. And so here we're back to the whole fiscal stimulus, a monetary stimulus story, is that when things start to slow down, we just need to juice the wheels of the economic machine to get consumers to feel confident and comfortable enough to go out and spend. But what happens if consumer confidence starts to roll over and head lower? Well, that's what we're about to see here in a bit. Check this out. Perhaps a peak pessimism is behind us. At least that's what policymakers are direly desperate to see, as August data indicates the economy is unlikely to suffer from a persisting deeper downturn going forward, even though there might be still some volatility ahead, especially if we take into account the policy factor. Now, there's a bet I'm willing to take, and this is the fear that policymakers have, because if you can't engineer a soft landing, well, then you just engineered yourself at the minimum a recession, if not some sort of financial or credit crisis. And that's the fear they're having here, is they want to believe that they've gone far enough, that they've just done enough, and that perhaps it's time just to pull back on those restraints to get the consumer to get out and spend. And in China, what we're about to see is those hopes are going to fade fast. The onshore yuan jumped as much as 0.5%, set for its best weekly advance since January. And this would make sense because it would suggest there's demand for currency, and the 10-year bond yield went up as well, and that would make sense. And policy tailwinds, while no massive stimulus, are gathering momentum. We're calling for a rally in the equity market. And of course, this is just enthusiasm as upon enthusiasm, even though we've made the case that the Chinese economy is doing rather poorly. You can see how desperate everyone is for some sort of hope. We've heard out of Beijing recently that they need the stock market to go up, and now all of a sudden they get a little bit of good data and everybody is cheering, buy stocks, sell bonds, enthusiasm, spend, 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 because if this thing doesn't turn around, there's no hope for the Chinese economy to save itself, and that's what you're about to see. Even so, it's the early days, and sure enough, and a single month of data isn't enough to confirm a sustained recovery trajectory, yet many people are very excited about that because there's been other signs that this year's initial spurt of spending activity has begun to moderate, and the ongoing crisis in the real estate sector continues to be a challenge. And that's all added to expectations that the government's policy push isn't finished, with several economists seeing more rate cuts or measures to come, which would suggest that these economists and other experts believe that the Chinese economy is going to get worse. It's going to force Beijing's hand to do some more stimulus, and that will get everything to turn around. But what's going on in their property market suggests by itself that any enthusiasm we see from the Chinese consumer is going to fade, and fade fast. as China's housing rally fades fast in big cities after stimulus. And you may remember when this package came out, I said on the show that it would be very limited. It would get the people out who were already planning on buying a house or were soon to be buying a house, and it would get them out and get some transactions. And then after that, everyone else would sit on the sidelines because there's absolutely no confidence that these builders even have the money to finish the properties that they have it being built, let alone to take on new projects. And you remember, this matters in China because people actually purchase a property, get a loan, and start making payments oftentimes before it's even begun being built. And when you see the developers have no money, well, there's no confidence you'll see your house. A spurt of home sales in China's biggest city is losing momentum, no surprise to us, and less than 2 weeks after authorities loosen mortgage restrictions, raising doubts over whether the steps are enough to revive the market before a crucial busy season. While a dearth of official statistics make it difficult to gain a comprehensive view, checks by industry watchers suggest that the rebound is fading in Tier 1 cities, suggesting the Chinese consumer isn't buying it at all. The sputtering recovery underscores China's struggle to arrest a record housing market slump, the stifling economic growth, and worsening a debt crisis among developers, because we know these developers are effectively running Ponzi schemes. They just keep getting new money in terms to use to pay on the older property commitments that they have. And unless they can keep this machine running, well, which it appears that they can't, at some point they start to hemorrhage, as we've seen, and this puts a major blowback on the banks. And next thing you know, the whole thing comes unraveled. And of course, we see that Beijing was just trying to give it a little nudge, thinking that perhaps the consumers weren't smart enough to realize what's really going on. And what we're starting to believe now is the Chinese consumer is in pulse with the with the global economy and what's really going on there. And they don't want to get in front of the firing line. Despite the recent market rescue efforts, Chinese real estate is now seen as the #1 source for the next global credit event. Something we've been saying is coming, and we've said the epicenter is likely to be China among investors surveyed by Bank of America. The ratio of investors concerned about Chinese housing sector more than doubled to 33% in September, and this is a dangerous sign. And yet, how long can sentiment stay positive remains a question, and sentiment is the theme of our show today, especially as supply rises. Listings for existing residents climbed 2.7% in Beijing, 2.3% in Shenzhen, and 0.6% in Guangzhou last week, accelerating from the week before. Now, you might think that is a sign of strength, or it's a sign of people that want to get out before things get worse. But one thing that is getting better, well, at least in terms of price, is crude oil, suggesting that many investors and speculators are starting to believe that not only is China going to avoid a crash, but the global economy is going to hit a mythical soft landing. But will it last? Well, probably not. The U.S. crude oil prices topped $90 a barrel now for the first time since November 2022. And keep in mind, this is going to feed back into inflation. It's going to cause the Fed to want to continue to hike more, as Saudi Arabia and Russia has extended their oil output cuts to the end of 2023. And a move that could result in a substantial market deficit for the rest of the year. From September onward, the loss of OPEC Plus production will drive a significant supply shortfall through the fourth quarter. Now, what we know will happen here is exactly what's supposed to happen. The U.S. consumer is starting to run out of money, as we're going to show you. Their confidence is shifting into the direction that we don't want, and higher energy prices will curb discretionary spending. We saw that yesterday in the advanced retail sales report. We're going to look at that a little bit more here in a bit and put a different spin on it so you can understand what's going on. But one thing that has worked and has worked consistently well is that's for our subscribers of our CTA-Timer Pro report, as we've been following this crude oil trade that the report recommended. And I showed you over in the show here, we could see that I'll show you it recommended a purchase here. If you were following oil looking for a rebound, it said this was the day to buy at open. Had you purchased that, you'd be up 8.3%. And we told you our upside target is still about maybe even a few dollars higher to taking the trade potential over double digits. And here you can see on August 31st, we see the machines flipping up or moving up and buying off of a trowel. That was the signal that came in. And here you can see they are maxed out to the long side as of September 4th. They continue to be maxed out. And we've made the case of why does machine trading matter? Because people usually follow it. When they see, of course, all this buying come in, they don't know where it's from. It's from the machines. And next thing you know, investors, speculators, money managers, everybody's on board, driving the price higher. But one thing that's not moving higher just yet, and that's the price of CTA-Timer Pro. It's $30 a month and comes with a 14-day money-back guarantee, so you can try it out. But now let's talk about the U.S. consumer, because is the change in U.S. consumer going to drive oil prices down? Is it going to change everything? It is, because there's red flags that are now popping up. As the University of Michigan inflation expectations plunged in early September, and it's not just inflation expectations that are plunging, it's also the way the U.S. consumers are viewing the economy. This from Zero Hedge, with CPI and PPI both printing hotter than expected, import and export prices rising more expected. Notably, they're still negative, as I'll show you, and the market's implied inflation expectation also soaring. This morning's much-watched inflation expectation index should be a little moot, but nevertheless, the survey respondents saw inflation expectations plunging, both short and medium term. So notably, what do we hear from central bankers around the world is that inflation is going to rear its ugly head. We showed you in the charts the other day that they're worried about this pullback and then massive surge of inflation, even though all the things that we would need to see that happen are not here. We're not seeing it at all, and yet consumers who do a much better job of figuring this out than these Fed officials say that inflation is likely coming down in the future. And one thing that is driving that is we see today export prices are down 5.5% from this time last year, although slightly improved from 7.9% last month. And how about the import price index? It's also slightly improved, but still negative. This is deflation. What you're seeing is deflation in export and import prices, down minus 3% year over year, a slight improvement from 4.4 last month. So you think about this from a business perspective. If your prices have gone up, your cost to do business has gone up because all of your expenses, including labor, has gone up. What do you not want to see right now is export prices go down. If you think inflation is rebounding, well, if import prices are down, remember, a lot of the stuff is made in China. We're importing deflation. That's how the game works. Let's check this out. Here you can see the import price index in end use for all commodities in blue against the consumer price index in red, both on a year-over-year rate change. And sure enough, we see a little bit push higher in import prices that are still negative, feeding into the slight increase in the CPI that we saw. If we do see crude oil prices continue to run higher, look for that to push a transitory push on inflation. But we're using the word transitory for a reason, because now we're seeing the headline sentiment indicator for the preliminary September data declined from 69.5 to 67.7, with current conditions tumbling while future expectations edged higher. And so now we're seeing what really matters here is the confidence in the U.S. consumer is starting to roll over. And I said this in a past show that if this changes, if the U.S. consumer starts to lose confidence, it will take their spending down with it. And with that, of course, will follow the entire U.S. economy at a time. Again, nobody thinks this is going to happen. We're going to hear from Fed Chair Powell next week about the strength of the labor market, how the U.S. consumer is robust, and what do we know about the truth of the U.S. consumer? They're drained out of their pandemic stimulus. There's a lot of them are facing student loan repayments. They're maxed out on their credit cards. And do you think they see hope here? They see inflation coming down. They're seeing, in fact, companies not hiring. They're not seeing the big wage growth anymore. It's all starting to go away, and that means confidence is getting zapped. And here you can see when we look at we see the consumer sentiment survey down slightly, showing that this preliminary data that consumers aren't quite as confident as they were last month. Looking here again, we see current conditions down from 75 to 69.8, but look at this, expectations nudge slightly higher. This is what you call the hope factor, that consumers are hoping things get better. And just like we started the show out as with China, as hope that maybe this is a bottom, because when you're down on the ground, at some point you have hope that maybe it can't get any worse. And that's what we start to see in these surveys until it does get worse. And here we can see from the retail side of this, one thing we can note is we talked about nominal retail sales yesterday. Now let's take a look at inflation adjusted or real retail sales, suggesting that the spend and the strength of the U.S. consumer is not where it used to be. In fact, we can note that anytime real retail sales goes negative, we can tell we're headed into a recession, or oftentimes we're already in one. And so from a retailer perspective, on a nominal basis, they're doing okay. But on an inflation-adjusted basis, as we made the case, they're not doing that well at all, and it's going to get worse for them, because if we do see a confirmed rollover in consumer sentiment, here we're looking at advanced retail sales on a year-over-year rate of change, that in blue, against the University of Michigan's Consumer Sentiment Survey in red. If this rolls over, now keep in mind this does not show the preliminary data, that is not reported to the Fred database. If this rolls over and heads down, well, look what happens. You can see every time it goes down, where does retail sales go? It goes down with it, suggesting that retailers will be the next place that start to have to lay off when they can't move their bloated inventories. And as far as crude oil, well, everybody believes that crude oil prices are going higher mainly due to the production cuts from OPEC Plus. But at the end of the day, it's all about the U.S. consumer. They can't afford higher energy prices. That means confidence rolls over. And even though we've seen in the global financial crisis that crude oil can indeed rally higher here, where the U.S. consumer goes, crude oil prices follow, suggesting that any rally here in crude oil, particularly if you're taking that trade that we showed you with our report, put a stop loss on somewhere or a trailing stop, because when it reverses, you make sure you want to hold on to your gain, because based on what we're seeing now, these red flags from the U.S. consumer, it's going to change at some point. But yet many people believe it may not matter at all, because the manufacturing sector in the U.S. is still running hot, but not for long. U.S. manufacturing production is lower year over year for 6 straight months, but remains positive as auto output maker plunges, which we should expect with the recent problems in the labor there with the strikes, that there are going to be more issues in this survey coming. But after surging in July, the U.S. industrial production was expected to rise modestly. Instead, despite signals from the ISM surveys that the industry is in contraction, the government says industrial production rose 0.5% month over month, and that pulled the year-over-year rate of change up to 0.25%, showing it just slightly in positive territory. But will it hang on? The answer is no, because if the U.S. consumer doesn't spend, and this is a real key part that I think people do not understand, that if the U.S. consumer doesn't spend and we see a rollover in sentiment, it's going to drag down U.S. industrial production. We can see the nice relationship here that tends to sell where the U.S. consumer goes. Industrial production is following it with a not too long distance lag. And when, of course, we see industrial production roll over and head down, that means the stock market goes with it. Here now we're overlaying the Wilshire 5000 or total U.S. stock market in red, both again shown on a year-over-year rate of change. And sure enough, the stock market believes that the economy is turning around, but if industrial production continues to fall, look for a reversal in the equity market in a big way. And that's something that a lot of investors just aren't prepared for. But what are we likely to see next week? Well, is the Fed going to tell us that we're at peak rates? Well, according to this Bloomberg article, the Fed is likely to shy away from calling the interest rate peak next week. Of course, why would they? They never tell us anything because they don't know what they're going to do. That's the key point. They give us all these projections, these dot plots, and all this information, and yet their own dot plots are actually the worst predictor of where interest rates are going than anything else that we have. But with inflation still above 2% and economic growth solid, at least for now, U.S. central bankers will retain a bias toward tighter policy at their September 19 to 20 meeting next week as they hold rates steady. So we keep seeing this. There's no way they're going to signal they're done here, and that's something that I agree with. They're never going to signal they're done, but in this is one case where in the past we've seen the Fed raise rates and pause for an extended period of time. I think we're not going to see them pause for very long when they do, because based on what we're seeing around the global economy and now this change in the U.S. consumer, they're starting to put up some more red flags. It suggests within months the Fed could be cutting and cutting big. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.